Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and sitting across from me is the one and only Lana Chen. Lana, today we are cracking open one of the oldest names on Wall Street.
Wells Fargo. Ticker WFC, 174 years old and somehow still making headlines.
That's exactly right. Founded in 1852 during the California Gold Rush, and today this company is a $2.1 trillion financial institution. Charlie Scharf is the CEO. He's been at the helm since late 2019, and just last year the board named him chairman as well.
Headquartered in San Francisco, roughly 205,000 employees. The story here is not just about size, though. It's about what happened to this bank and what's happening now.
So let's set the table. Wells Fargo makes money through four segments. Consumer banking and lending is the biggest. That brought in $36.2 billion in 2025. Then you've got commercial banking, corporate and investment banking, and wealth and investment management.
Think of it as a full-service financial supermarket. Checking accounts, mortgages, credit cards on one side, commercial real estate loans, investment banking deals, and wealth advisory on the other. They touch every corner of the banking world.
And the history is wild. This company literally started with stagecoaches carrying gold across the frontier. Fast forward through two mega mergers, Norwest in 1998, Wachovia in 2008, right during the financial crisis, and Wells Fargo became a coast-to-coast banking powerhouse.
But then came 2016, the fake account scandal. Employees had created roughly 3.5 million unauthorized accounts to hit aggressive sales targets. The Consumer Financial Protection Bureau hit them with fines. Congress held hearings, and in February 2018, the Federal Reserve did something unprecedented.
The asset cap. The Fed capped Wells Fargo at $1.95 trillion in total assets, essentially freezing their growth. For 7 years, while JP Morgan and Bank of America were growing their balance sheets, Wells Fargo had its hands tied behind its back.
That brings us to why this stock matters right now. In June 2025, the Federal Reserve unanimously voted to lift the asset cap. 7 years of regulatory purgatory, over.
And you can already see the impact. Assets grew 11% year over year. The bank crossed $2 trillion in total assets. They're growing loans, growing deposits, and their investment banking franchise jumped from 17th globally to 9th in M&A rankings. Charlie Scharf literally said, and I love this, "The world is our oyster now."
Which is a bold statement from a CEO who spent 5 years cutting 55,000 jobs and dismantling the old culture. But the numbers are backing it up. Let's get into them.
Take it away, Lana. This is your domain.
Let's start with valuation. Wells Fargo trades at $81.75 as of today. That gives us a market cap of $270 billion. The PE ratio on a trailing 12-month basis is 13.8 times earnings. Forward PE is 13.6.
That seems pretty reasonable for a major bank.
It is. Price to book is 1.63 times, and the PEG ratio is 0.93. Anything below 1 on the PEG tells you the market may be underpricing the growth. For context, JP Morgan trades at nearly 15 times earnings and Bank of America at 13.5. So Wells Fargo is right in line with its peers, maybe a touch cheaper when you factor in the growth runway from the cap removal.
And the 52-week range?
The stock hit a high of $97.76 back in January, and the low was $58.42 about a year ago. So it's pulled back from the highs, currently sitting about 16% below that January peak.
All right, let's talk income and growth.
Revenue on a trailing 12-month basis is approximately $85.2 billion. Growth has been modest, around 1.5%, but that's about to change. The key number for any bank is net interest income, and Wells Fargo posted $47.5 billion in NII for 2025. The guidance for 2026 is approximately $50 billion. That's a 5% jump.
What's driving that increase?
Balance sheet growth now that the cap is off, changes in loan and deposit mix, and continued repricing of fixed-rate assets at higher yields. Earnings per share came in at $6.27. And here's the impressive part. EPS grew 17% year over year.
17% earnings growth at a bank this size. That's not nothing.
It's driven largely by efficiency gains. The operating margin is 29.1%. Net margin is 25.4%, and the efficiency ratio, this is the metric that Scharf lives and breathes, came in at 61% for Q4 2025, down from 65% the year before. The target for 2026 is 60%.
For folks who don't speak banker, the efficiency ratio measures how many cents a bank spends to generate each dollar of revenue. Lower is better.
Exactly. JP Morgan runs in the high 50s. Getting to 60 would put Wells Fargo in elite territory, and Scharf is doing it through headcount reduction, down from 275,000 to 205,000, process simplification, and increasingly, artificial intelligence.
What about the balance sheet?
Total assets are $2.149 trillion. CET1 capital ratio, Common Equity Tier 1, the key regulatory capital measure, is 10.6%. That's well above the required minimums and gives them plenty of capacity for growth and capital returns.
And returns?
Return on equity is 12.3%. Return on tangible common equity is 15%. Return on assets is 1.11%. These are solid numbers, not best in class. JP Morgan runs a 16% ROE, but improving every quarter.
What about dividends?
The current yield is 2.24% with an annual dividend of $1.80 per share. The payout ratio is 30.4%, which leaves plenty of room for increases. But the real capital return story is buybacks. They've authorized a $40 billion share repurchase program. That's roughly 15% of the entire market cap.
$40 billion in buybacks. That's a serious statement of confidence.
Overall, Wells Fargo's financial health is solid. The turnaround is real. The balance sheet is well capitalized, and the growth trajectory post-asset cap is accelerating, though commercial real estate exposure and margin sensitivity bear watching.
All right, let's talk about what the street thinks. 30 analysts cover Wells Fargo. The consensus rating is buy. The median 12-month price target is $95, which implies about 16% upside from current levels. The range goes from 83 on the low end to 101 on the high end.
The bull camp is larger. 19 analysts rated a buy or strong buy, and 11 have it at hold. 0 sells.
0 sells on a bank that was under a regulatory consent order for 7 years. That tells you a lot about how the street views the turnaround.
On the insider front, it's a mixed picture. Net selling over the past 90 days, about $10 million in total sales. EVP Ellen Patterson sold 60,000 shares in February at $87.40, netting about $5.2 million.
Is that a red flag?
Not necessarily. Insider ownership is very low at 0.08%, so these are more likely planned dispositions for diversification. I'd be more concerned if we saw multiple C-suite executives dumping shares outside of prearranged plans.
Fair enough. Let's talk about the most recent earnings. Q4 2025, EPS came in at $1.76, beating the estimate of $1.66. Revenue was $21.3 billion, above the $20.8 billion estimate.
Both a top-line and bottom-line beat. The efficiency ratio improved. Credit card accounts grew 21%, and deposits grew meaningfully for the first time in years. The guidance was bullish. $50 billion in NII for 2026, mid-single-digit growth in both deposits and loans.
And the next earnings report drops on April 14th. That's 5 days from now. The street is looking for $1.57 in EPS and about $21.75 billion in revenue for Q1 2026.
It'll be the first full quarter where we can really measure the momentum of the post-cap era.
Let's do the bull and bear case. I'll take the bull side. The biggest catalyst is simple. For 7 years, this bank was handcuffed. The asset cap is gone. Total assets have already jumped 11%. Loan growth is broad-based. Deposit growth is exceeding market rates. This bank can finally compete.
And the efficiency story is real. Scharf has taken the headcount from 275,000 to 205,000, while revenue has held steady. If the efficiency ratio hits 60%, that's hundreds of millions of dollars flowing straight to the bottom line.
The investment banking franchise is surging, from 17th to 9th in global M&A in 1 year. Management is targeting top 5 by year-end 2026. That fee income diversification reduces the reliance on net interest income.
And the buyback program, $40 billion authorized. CET1 capital at 10.6% gives them the firepower. At current prices, that could reduce the share count by 5 to 8% over the next 18 months.
Now, give us the bear case, Lana.
Commercial real estate. CRE is 16% of the loan book, and the office segment is under significant stress. Wells Fargo has already reduced its office exposure from 13% to 9% of total loans, but the refinancing cliff is real. Over 50% of CRE loans come due in 2026 and 2027.
And the Fed's stress test flagged this.
It did. Under a severe scenario, Wells Fargo stood to lose $13.4 billion, one of the highest potential loss figures among the 31 banks tested. That's a real tail risk.
What about regulation?
The asset cap is gone, but other components of the 2018 enforcement action remain in place. Board oversight mandates, enhanced risk management reporting, third-party monitoring, and there's a newer OCC enforcement action on AML and sanctions compliance. Regulatory costs aren't zero just because the cap was lifted.
And the rate environment.
Wells Fargo's own outlook calls for 0 Fed rate cuts in 2026. That's bullish for their NII guidance. But if the economy softens and the Fed is forced to cut aggressively, that $50 billion NII target comes under pressure fast. Net interest margin compression is the number one earnings risk for any bank.
And competition from fintech.
It's real but manageable. Neobanks are chipping away at deposits, especially among younger customers. But Wells Fargo's 4,000-plus branch network remains a durable advantage for relationship banking. The key is whether they can improve deposits per branch, which is currently below peer benchmarks.
Let's stack Wells Fargo up against the competition. How does WFC compare to JP Morgan, Bank of America, Citi, and US Bancorp?
On valuation, Wells Fargo's PE of 13.8 is right in the middle. JP Morgan is at 14.9, Bank of America at 13.6, Citi at 16.5, and US Bancorp is cheapest at 11.8.
Citi trading at a premium to Wells Fargo feels odd.
It does, especially when you look at returns. JP Morgan leads with an ROE of 16.1%, Wells Fargo is at 12.3, Bank of America at 10.6, US Bancorp at 11.7, and Citi trails at 6.8%. On net margins, JP Morgan again leads at 33%. Wells Fargo is second at about 25%. Citi is at 17%.
So JP Morgan is clearly the gold standard, but Wells Fargo is solidly second among the big four.
On most operational metrics, yes. And the growth delta matters. Wells Fargo is the only one of these banks that just had a structural constraint removed. The others have been optimizing continuously. Wells Fargo has 7 years of pent-up growth to unlock.
Let's bring it home. The bottom line on Wells Fargo. This is a 174-year-old bank that went through a genuine crisis, self-inflicted, and spent 7 years paying for it. Under Charlie Scharf, the turnaround is real. The numbers prove it. 17% EPS growth, an improving efficiency ratio, a growing balance sheet, and a massive buyback program.
The single most important number to watch going forward is net interest income. If they hit that $50 billion NII target for 2026, the stock has room to run toward the street's $95 target. If NII disappoints, particularly because of rate cuts or credit losses, the pullback could be sharp.
The street sees 16% upside. The valuation is reasonable at under 14 times earnings, and the PEG ratio below 1 suggests the growth isn't fully priced in.
But keep an eye on April 14th. That Q1 report will set the tone for whether this post-cap growth story has real legs or if it's already in the price.
We'll leave you with a quote from the man running the show. Charlie Scharf, CEO and chairman of Wells Fargo, said, "The world is our oyster now."
After 7 years of having the smallest oyster on Wall Street, I'd say he's earned the right to be hungry.
Before we wrap up, if you want more deep dives like this one, head over to chargedalpha.com. Every episode, every chart, every data point, it's all there. And while you're at it, subscribe wherever you listen to podcasts so you never miss an episode.
We publish new episodes every earnings quarter, covering the entire S&P 500, one company at a time.
That's our deep dive on Wells Fargo, ticker WFC. From the stagecoach to the S&P 500, still rolling.
Still rolling, though the horses are AI-powered now.
This is Charged Alpha, the S&P 500 stock encyclopedia.
The information presented in this episode is for educational and informational purposes only and should not be considered financial, investment, or trading advice. Charged Alpha does not recommend buying, selling, or holding any securities. All data is sourced from publicly available information and is believed to be accurate at the time of recording, but accuracy is not guaranteed. Past performance does not indicate future results. Always do your own research and consult a licensed financial advisor before making any investment decisions. Additionally, portions of this episode's research and production were assisted by artificial intelligence tools. All AI-generated content has been reviewed for accuracy, but listeners should verify any specific data points independently.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street